Hello, everybody. Welcome. Tuesday afternoon. Told you guys I was going to be live down here on the floor of the CBOE. Just had all of our fly-ins with me down here on the floor. I think they went back to the office to go watch. But how is everybody doing? Can you hear me okay? Can you see? Well, there's not a lot of activity going on down here. It is very quiet today. S&P's just off their lows of the day right now, down about 13 and a half points, but it is really quiet. Volume is very light today. Oh, Bear, thank you. You mean the floor is looking good, not me. I know that for sure, right? All right, everybody. We're going to talk about Vol Crush. I know we've done this before, but the reason I want to do it again right now is because it is earnings season again. So I think a refresher for those of you that have listened to this before is probably good. And for the rest of you, it is super important to know and understand what Vol Crush is, especially going in to earnings season. All right. So before we start, everybody hit the like, smash the like, subscribe, all that good stuff, please. If you can do that, would be very appreciative. And yesterday, I think, Mike, was yesterday the most amount of eyes that we had on an episode? No, not quite, but it was up there. Hopefully we get to that today also here. Everybody can hear me okay before we start here? Excellent. Excellent. Okay. So, what are we going to talk about? How do we trade the post earnings IV crush? Okay. Again, I know that we have been through this before. We're going to do it again. I've got some live examples ready to go here. Okay. And there is an art to doing this. Okay. And for those of you that grew up with this like I did, hopefully you can enjoy a little orange crush. All right. But that's what this is all about. Now, before we get started on this, we know with 100% certainty going into earnings, volatility gets elevated, right? And it gets elevated because we know that on earnings day, there is one time, one day out of the cycle, typically 3 months, so one day every quarter, where a company is going to come out and they are going to announce material information about their company, health of the company, finances, sales, whatever it might be. So they announce this. The other 89 days of the quarter, they don't. So, in anticipation of this very material news, that the company is going to announce, that's what makes volatility increase because there is a lot of uncertainty. Uncertainty makes volatility increase. Hey, Kevin, what's up, man? So, what we also know with 100% certainty is besides volatility increasing into earnings, we know that this crush is going to happen afterwards, regardless of what those earnings results are, good, bad, indifferent, whatever it is, volatility will get crushed. Volatility will normalize. What do we mean by that? Okay. How do we know it will happen? We do because it's tried, true, and tested. So we know it will happen. And I will show you proof of that on the charts. When will it happen? Immediately. Immediately. So if a company announces earnings after the close one day, they will then, the following morning, wherever the stock is, that volatility is going to come crashing down. How much will it drop? We're going to go into that. Okay. And then we'll talk about Vega versus IV, implied volatility. Okay. Let's take a look here, everybody. And hopefully this isn't too hard to see. Okay. These are some charts I pulled from Netflix. When I did this, the stock was trading 1260. Okay. So if we look at the money implied volatility here, 93%. Whether it's at the money or the out of the monies, okay, it is highly, highly elevated. Does everybody see that? I'm hoping by, bless you, I'm hoping by circling with the yellow marker, everybody can follow it. Hey, Steve, Victor, thank you, Kevin, for smashing away. Okay, now this is, if you'll notice, this week's expiration. Netflix earnings come out Thursday after the close. This is this week's expiration. Okay. If we go to next week, and if we were to go to every subsequent week afterwards, going further out, we would see that the implied volatility, though elevated, is not as high. So if we go back, here's our 1260, we can see that next week's implied volatility is only 58. Same for out of the monies on either side here. 93 for this week's implied volatility, 58 for next week's implied volatility. You would think, boy, this is a no-brainer, right? This is what I should do. I should sell that 93 and buy that 58, right? Wouldn't it make sense that you would want to do that, knowing with 100% certainty that volatility is going to come crashing down and normalize to where we were? It would certainly make sense. However, that is not always the case. So let's take a look at Netflix's 1 year implied volatility. Okay. As we can see, we get spikes and we get dips. Okay. We know with 100% certainty this pattern will continue. We will see that spike up prior to earnings. We will see it normalize after earnings once that uncertainty is gone. So if we were to look at this and say, okay, what is over this period of time, which is 1 year, what is a kind of fair implied volatility? If we were to draw kind of the midline, right? I would say it's, probably somewhere throughout here, maybe somewhere in the mid 30s. Okay, let's call it 35%. Okay, everybody following along? Everybody see that? Okay, good. So if we look at this chart still, we know when vol gets down here, that's a time to buy volatility in Netflix. Now, buying volatility doesn't mean you're bullish or bearish. In fact, you could be neutral. You could be bullish, bearish, or neutral. What it means is buying premium. That premium could be on the put side, it could be on the call side, it could be a combination, whatever it is. But we know when implied volatility gets down there, okay, it's a buy. Just like if you were looking at a stock chart, you were looking for support, resistance at certain areas, that would be major support. We also know that when vol gets on some of those spikes there, we want to sell it. Okay, because again, we know with 100% certainty that vol will normalize. That is one of the characteristics of implied volatility. It will always, always normalize. Now, because of, I don't know if you guys heard that. That was like the first big order here since I've been down here, and I've been down here for 45 minutes or so. Oh, look at that, Mike. They have the big Kingsview logos up there. Nice. Nice. This is pretty cool, actually, everybody. My son, who works for a big investment management firm, is doing a podcast here in about 15 minutes, actually. Can't wait to see him. Okay. So anyway, because we know that big, quick adjustment, okay, is going to happen, we need to prepare for that. we need to value these options as if it were already post earnings. Because if we don't, we will not, we will not get an accurate description of what a potential P&L would be. So on this screen here, I've gone back to this week's option chain. But what you'll see I've done here is I've added in where I believe the implied volatility is going to go after earnings. Okay. So in this week's IV, from 93% all the way down to what did I put in here? 63, 65. Okay. And I'm going to go through with you. I'm going to go through with everybody how much we should anticipate adjusting. Okay. But does everybody see the adjustment I made it? And what this does then is when I adjust the implied volatilities here, it gives me the adjusted theoretical values. So I can appropriately value a position I'm going to take. So I can appropriately evaluate, is that 93% implied volatility that we're seeing in this week's options, is that really that much more expensive than the 58% that we're seeing next week? We have to evaluate that. We have to compare them on a post earnings adjusted basis. Okay. So now let's look at that week 2 implied volatility. And you'll see the adjustment I made down to about 35. Any reference? What was so important about that 35 that I adjusted there? What did we just review? What was so significant about that 35? Bingo. Exactly, Kevin. That's probably the best guesstimate of where vol is going to normalize to. And let me throw that screen back up here again so you can see it right here. Here is this 1 year chart. I could have picked 6 months. I could have picked 2 years. I just chose 1 year here. And we can see that mid-range there. Now, maybe it dips down a little further. Maybe it doesn't dip quite as much. But that is the adjustment I am going to make to get what I believe would be a fair assessment of implied vol, and then a fair assessment of what the new theoretical value of those options would be. Okay, does that make sense for everybody? Okay, so how much do we make that adjustment? Okay, how much do we make that adjustment? This is really important. This is really key. Okay, now you will not find this information on YouTube, on the internet, anywhere. Well, you will on this YouTube channel, but not somewhere else. Okay, you're not going to find that out there. These numbers that I have up here right now, this assessment that I have up here, this is based on me doing this for 35 years and from all of my experience and what I see. So if you are going to put on an earnings position and you have the first week options. So when I say first week, earnings are Thursday for Netflix. So this Friday's expiration, you could expect a decline in implied vol after earnings of about 50%. Okay. You could expect about 50% for the next week. You can expect a decline of typically about 40 to 45%. And then every subsequent week is going to be less and less and less and less because going into earnings, there's not going to be that much of a pump up in vol for it to come back and normalize. Does everybody understand that?
I do, but I don't want to go out of question. Yeah, you don't mind.
Gene, is okay mean yes, you understand it? Okay, Steve, Dave, Kevin, awesome. Okay, before Robert, excellent. Before we go on here, let's get Thor's word of the day here today, which is crush. Let's get that up here real quick. It's funny now, as the S&Ps are kind of ticking down a little bit on their lows of the day, the volume level is getting a little bit higher out here. That's typically what happens as the market is on the downtrend. Vol picks up, things pick up here a little bit. Okay, we'll give this another minute or so. Hey Todd, how you doing? All right, Connie, how you doing? Okay, I'm going to go back to this here. Does everybody understand what I mean by seeing this decline? Okay. In implied volatility. And what I mean by the 50%, the 40%, does everybody understand that? Excellent. Thank you, Kevin. Okay, Kevin, since you were the first one to answer there, give me a stock you want to look at that has earnings coming up. And you know what? Let's look at the screen here and somebody pick, or Kevin, pick any of these stocks here that have a blue E next to it, because those are going to be the ones that are on my watch list that have earnings coming up. All right. Triple M. Wonderful, wonderful, wonderful. Okay, Triple M. They have earnings Friday morning. Okay. They have earnings Friday morning. You can see I know that because it says it right up here, 7:18 before the market. Now, when I trade something for earnings, okay, I typically don't like to trade when earnings are on a Friday because it can just be a little bit more difficult to adjust a position. So when I say I don't trade, I will absolutely look to trade Triple M, but I won't use this week's options. I would use next week and the following week. Okay. So let's say that we were looking to do a calendar spread. Okay. Kevin, are you bullish or bearish in Triple M? There's no right or wrong answer here. This is just for explanation purposes here, guys. There's no right or wrong answer. Kevin, there we go. Okay, you're bullish. Okay, no, Kevin, you're bearish. Aladdin, you're bullish. Kevin, you're bearish. We're going to go with a bearish setup here. So here is the implied volatility chart in MMM for 2 years. Now, in a stock like Triple M, and some of the other old time stocks, Coca-Cola, Pepsi, IBM, stocks like that, you're not going to see as significant of an adjustment in implied vols going into an earnings. So that's why these shifts aren't quite as big as what we just saw on Netflix. Nonetheless, we can still evaluate the same thing. So, Kevin, you were bearish. We're going to look at a calendar spread in Triple M. What would be the first thing we would look at here, folks? How would we determine what strikes we potentially want to trade? We need to figure out the expected move, right? We need to figure out the expected move. Excellent, Robert and Bear. Kevin. Okay. So with Triple M trading, what is that, about 156 right now? If I'm looking out to next week, what do you guys see as the expected move for next week? Anybody? All right, S&Ps are off their lows. They're still down 13 points here, but off their lows. Okay, we got about 945, $10. Next week, not this week, guys. Okay, I'd say it's probably closer to 10 for next week. We'll go with 10. Okay, Kevin was bearish. That means if we're going to look to do a calendar put spread, let's say, because we want to see if those implied volatilities are going to be in line or not, we're going to look down at around the 145, 146, or 145 strike. Okay. So what I'm going to do is I am going to put in here my 145. Now, next week is the one we're selling. We can see the implied vol is up at 45%. Where should I adjust that to for next week? We know it's not going to be 45% when earnings are over. Maybe we need to go back to the implied vol chart here. Okay. Will Nice, we calculate the expected move by looking at the money options, both the call and the put, and adding them together. Okay, Steve, you say 20 to 25. Okay, it's a great start. Kevin, you say 30. Okay, now half of where it is right now would be 22. Okay, half of where it is right now would be 22. That's probably a little bit low just given where implied vol is right now and the fact that Triple M doesn't move so much, right? If I were to look at 22 here, I would see that's the absolute bottom. Like that's big time support, right? That is big time support. I'd be a buyer of vol there. So it's probably more likely 20, mid to higher 20s, let's say 26, 27 or so. So I'm going to make that 27. Okay. Now, if we want to do a 1 week calendar spread, let's go out to the following week, which is August 1st. Okay. And we're going to look at the 145 put. Okay. And we could see that it is already way lower as it should be. Okay. It's about 38 or so. Where should we adjust that to? Where should we adjust that one down to? Okay, I like that. 25 is good. Probably I'm going to be a little bit more careful knowing that this is the option I'm buying, my long option. And I probably want to even lower it even more just to have a little room, to have a little in case, right? I'd rather be more conservative in my projections here. So I'm going to lower that to, let's say, a 23. Okay. So now I've lowered next week's options down to whatever was 28, the one we're buying down to 23. Now I will have a much, much better handle on what the value of this spread should really be worth. Okay. Now we could probably buy this spread for, I'm saying 30 cents. The market on it is 17 bid, offered at 44. Maybe it's 35 cents. Okay. Maybe it's 35 cents. Okay. How do we know if that's good, bad, or indifferent? How do we know if 35 is good or not? We don't until we plug it into our risk graph, which I'm going to do right here. Okay. So here is my risk graph. What I'm going to do is I am going to bump up the date because remember, the short option we're using here is next week's option. So I'm going to bump up the date here to mid next week. Okay. And our target, as we know, we always want stock to move to the short strike, 145. So if we got that move, okay, if we got that move, that's what the profitability is showing with the adjusted implied volatilities. Does everybody see that? So if we paid 35 cents for this and we got the exact move we were looking for, we could assume we'd probably make a little bit better than 1-to-1, 40, 42 cents, something like that. Okay. Does everybody see that? Now, would I do that? I probably wouldn't do that. I like the 1-to-1. That's actually really good. I like the 1-to-1, but this is a pretty tight window that we would have to hit to make some money, right? If we don't get that move that we're looking for, ain't going to be good. So I'm probably not going to make that trade, but I have to evaluate it post earnings. Absolutely have to evaluate it post earnings. Now, what I am doing here, okay, I just changed something. Why do you think this graph, whoops, get back on that. Why do you think this graph looks way better than the first graph? Let me get this back on here. Let me do the same comparison, moving the date ahead. Okay, look at this P&L. Why all of a sudden is not only the potential profit double, 2.5 times as much, but we have a much wider zone where we could make money. Why do you think that is? That's because what I did here is I ran this risk chart, which you could all do on whatever platform you are on. I ran this risk chart with no adjustment to the implied volatility. So if implied vol stayed the same, if implied vol stayed the same as to where it is right now, look at the difference in what the projected P&L would be. If this was my projected P&L with the adjusted implied vol, I would do this in a heartbeat. This would be unbelievable. But this reflection right here, if you were to put this in your platform, Thinkorswim, whatever you're using, put this calendar put spread in and just run your P&L, this is what you're going to see. This is not accurate. This is not accurate. It is erroneous. It's giving you the right information, but it's giving you the right information based on volatility remaining the same and not getting crushed. Does that make sense, everybody? And I can continue more on this tomorrow if you would like. We can do another example tomorrow. In fact, maybe we will, because this definitely is a bit deeper of a conversation. The bottom line is, if you are going to put on an earnings trade, you must adjust for implied vol. All right, guys. We have an on the floor special wheel here today. All right, here we go. We are pretty full, which is great. Let's get the wheel rolling here, folks. Winner, winner, winner today is Bear. Bear, you are always the winner. You are always the winner. Nicely done. Should we do one more, folks? Since Bear is a multiple time winner, let's run it one more time. All right. Let's run it one more time. Here we go. All right. Marty or McCarty or Nico. McCarty. McCarty, are you in the house? McCarty Punter, are you in the house? You guys know what to do. Email me at prosperswag@prospertrading.com. Mike, did you just remove? Oh, that was weird. Okay. McCarty, yes, you are here. Winner, winner, winner. Nicely done, McCarty. All right. It looked like, I think the yeses that I got before were to do a continuation tomorrow. So I will do a continuation tomorrow. All right. Everybody, thank you so much. Have an amazing, amazing day and see you tomorrow.